Hello traders, Gary Wagner here. Just before 2 o'clock in Honolulu, 7 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is the 26th day of February, 2021, and this is the Daily Report for Gold and Silver, our weekend review, and we really went through quite a week. A raise in yields from Treasury notes really precipitated massive sell-offs in U.S. equities along with the precious metals. However, on today, I want to take a little bit different of an approach and look at the big picture by looking at something called Elliott wave supercycles to project what we might see in terms of gold pricing in the next upcoming months. Hope you enjoyed the show. As we have been speaking about over the last couple of weeks, we have definitely seen gold under pressure and are under the belief that we are currently in a correction. On today's report, I want to focus on the big picture of gold by looking at the long-term Elliott wave count, what we call part of a super cycle, to project where we believe gold might go. Today, gold did close down $42.40. That is a decline of 2.39% and is currently fixed at $1,733 per ounce. I want to take a look at the big picture, and to do that, we're using a monthly continuous contract of gold futures. We're really focusing on a series of the last waves, waves 3, 4, and 5, in attempts to calculate what we could see in terms of the correction that we're currently looking at. And the way that you want to look at it is really at first quarter of 2001, gold was trading around 250. From there, it rose to a high of 1920, and that is being labeled as a major third wave. From there, we had a multi-year correction also, and that took us from the middle of 2011 down to the lows, about $1,000.20. From there, we're looking at this fifth wave that took us to a new all-time high of $2,088. And over the last, call it 6 months, we have seen this market correct from that price down to current pricing at $1,723. Now, with that in mind, we are able to do some forecasting. For example, the standard practice of looking at a third wave to the fourth wave to project the top of this fifth wave can be done in one of two techniques. You either use wave 1 as a one-to-one relationship, or you use a Fibonacci extension of 0.618 to project where wave 5 might go. And we've done just that, and I'll go ahead and put that up on the screen, the projections themselves. And what you'll see is something quite interesting, and that is this. When we take a look and we project the move in wave 3 and then start our extension from wave 4, you can see that this is our line here to here, and then we start from here. The projection we're running, this is a 0.618% projection, and you can see that that comes in at 2071, very, very close to the actual top of the market, which was 2088. And on this last chart that we're going to look at for gold and our big picture view is that monthly chart. But here we've basically done first a Fibonacci retracement of the fifth wave, which begins at 1020 up to the new record high here. And what I'm looking at is various levels the market could fall to. We're definitely in a correction, as I said. We can see that by price decline here. But the first real level that seems logical to look at for our A wave, because we're going to have a series of 3 waves, would be a 38. The total correction could be much steeper than that, but let's go under this assumption as our first model. Then what would happen is you would get a counter wave, a B wave, and the B wave will typically take you anywhere between 50 and 75% that of A, which would take you anywhere between, call it 1890 and 1990 in terms of a nice bounce and a rally, and that would be followed by a final C wave. If the C wave concluded at the same price as the A wave, it's called a flat, and if it goes below that, it is called basically a zigzag ABC, which could take us to much lower pricing. I'm the optimist, and I would look for a flat. It can also unfold as a compression triangle where you have an A, B, C, D, E, and then a thrust line, but that's another model that we can discuss next week. None of the precious metals were immune to the raise in Treasury yields, which really sent havoc into both the U.S. equities markets as well as the precious metals markets. Luckily, we did raise our stops and pulled small profits on our silver futures, Forex, as well as our SLV positions. Silver futures, basis the most active March, $26.70, a decline of 3.56%. If you recall from yesterday's show and the trade alert that we sent out, we did move our stops in our long silver trade to 27.39. And while our original model suggested it might go to $29 or $30, the recent rise in the 10-year notes predicated a real shift in market sentiment, and that is what caused us to restructure our model. We also had our stops hit in our long SLV, the iShares Silver Trust. However, you have to note that they do not trade as a continuous market. So if you see the closing price here at $25.50 and then it opens here at $25 per share, we had moved our stop up to $24.99. So we really got out right where our stop was on the open of the market at $24.99. We purchased our first leg at $22.95, our second leg at $24.60. So we did make on both legs of this trade. I am sorry to report to you, but we did take a loss on our long platinum trade. We entered that trade on February 18th when we had platinum trading at $12.82. We had our stop at $12.17, and that was hit. Market is currently at $11.92.80, so quite a ways away from the stop. The total decline on the trade was $65 or $3,200 per contract. And traders, Elliott wave theory is probably one of the most controversial technical systems out there. It's an art as well as a science. There's no pure black and white because you can do different models. And I hope that you found this interesting and enlightening, and it will give you some insight as to where gold pricing could head from here. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.